when you start off with your paper on any paper like this, you've got to make sure you give some intro to it. So some intro to the company. He's doing Adobe. Probably his boss knows who's doing this. But if you look in practice, the portfolio manager might be a consumer services, consumer retail, communication services person. May not know the tech industries. So your portfolio manager might actually not know as much about the companies as you may think. Usually portfolio managers had some sector background. So you want to start off with the company. You could do that in your abstract. You could do it in your first paragraph. Adobe has been an industry leader. So he started off there talking about who they are when they got formed. Adobe is a little bit of a monopoly type of firm because they're so heavily used by desktop publishing and certain musicians and other types like them a lot. So that gives them a huge advantage. They went digital a few years ago, which had a huge impact on them. So he gave a good introduction. So I'm not looking for much. It's not a huge part of the paper grade, but it is important that you put something in there. And then it's just obvious looking at the data, you're going to talk this number. You're going to talk that number. You might, I can't remember you talked this one, you might talk this number. There's a pretty big difference there. So how would you word that? You'd say Adobe reported EPS of 4.48, 3.345 before whatever that is. I don't know why there's such a big difference in those two. If there's not a difference, you don't have to say anything about it. But if there's a difference, you probably want to say what that difference is. And then you say which, did it beat or miss? The expected 4.38 by 2.33%. And was it higher or lower than last year? 17.9% higher than same quarter last year. Real simple. You talk those three numbers. Talk the percentage changes. You don't necessarily have to say that number. I would give the expected. I think that makes sense to give the expected. You don't necessarily have to. You definitely have to get the percent. Always get the percent. Don't I either give the expected or get the percent. You always want to get the percent, so your boss doesn't sit there and say, well, they beat by 5%, they beat by 10%, give them that percent. I like to give the amount as well. I just think that makes sense. The prior year, yeah, it's prior year. A lot of times I just give the percentage change. All right. You notice I don't use this number at all. Once you say the 448 and compare, the only time you say the 335, the 3.345 is maybe one time, get it out of the way. If you can't find why there's a big difference there, then maybe you just leave it out. The market is entirely focused on this number. This 2.33%, that's not the number. I didn't give you this 2.33. That was what was in Bloomberg. So even Bloomberg is comparing those two numbers. They're not looking at the actual reported GAAP number. All right. So pretty important. So let's see how this student did. Adobe recently released their full year Q1 earnings report. He gave the date it's released. That's a good thing to do. It's kind of good to say after close or before open to give some indication on that. That can usually be good. Was $4.4. There is a typo here. It wasn't 4.48 billion. This is earnings per share. All right, so take that billion out. Take the billion out. I didn't catch that when he showed it to me earlier. That's not 4.48 billion. It's $4.48. All right, because it's earnings per share. Did I do it correctly on the Yeah, see here, there's no billions. There's billions there. So that is $3 and that is $4.48, which is 2.33% beat over the expected and significantly higher than the prior quarter last year. All right. So I would probably count off for the billion being in there, but who knows? I want to scare them a little bit. So, like, no, I'll give them a little more than that. Probably 95. But yeah, be careful. It's not in billions. That's actual dollars. Probably give them 100 there. Revenue, exact same thing here on revenue. Revenue, it's rare that there's a difference. I have seen some companies that are different, but I wouldn't talk about it at all because it's so bizarre. Same thing on gross margin, you'll see differences. I would only say the difference once. So here I would talk that number, that number, that number. I probably wouldn't give the prior year. I would just give the percentage change from the prior year. Usually on revenue, you're much, much closer than you are on earnings. But a slight beat, slight miss can be a big deal on some of these stocks. Reported gross margin, where's revenue? Revenue recorded 5.18 billion in revenue, which was a beat and increase. So that's fine. No issues there. It's really hard jumping back and forth, but. And in bottom line, talk about margins. Reported gross margin is 90%, which exceeds expected by 63 basis points and surpasses prior year by 42. He talks EBITDA. You can talk EBITDA in dollars if you want to. EBITDA margin was reported at 51, exceeded estimate by 182 basis points. So yeah, an increase of 137 basis points. So there's just a matter of giving me the numbers, very straightforward. And I gave you the numbers, so you don't have to do the calculations yourself. So give the margins. Margins have been really, really important recently because of inflation. So you're trying to ask, is inflation squeezing margins? So then the key, so he gave the numbers. The question is, how does he explain those? So then he has a discussion. So all the numbers are in there. So 20% is the analysis. And by analysis, they explain why these numbers are there. So this is the firm that has beat on everything. All of these are beats. All are higher than last year. So that sounds like really, really strong performance. But then you go down to the stock price, and what did the stock price do? Stock dropped 13%. So he probably wants to set that up somehow. All right. He could set it up at the very beginning in this title up here and say, while Adobe beat on expectations and increased from last year, the stock market still had a negative reaction. This paper will explain why the market reacted, something like that. Either set it up, or if you don't set it up, everything's positive, then you get to market. Your first word on the market might be, surprisingly, Adobe stock was down 13%, even with all this positivity. If you set it up, then you set it up and say, given management's negative outlook, even with the beat, the stock market was, you somehow transition to the market reaction by setting it up in what you say above. So let's say if he's negative, very strong results for Adobe's earnings should come as no surprise, ability to sustain. Yeah, they are a leader in 1980s. So he's giving me some history. Gave a quote, we have an opportunity to reinvest. Both customers and investors were skeptic of this shift. So yeah, they went from subscriptions to digital. Went from mailing out CDs to online subscriptions, which had a huge impact on the firm. instead of getting like $50 up front, you're getting $5, whatever, a month over the next several years. You know, it was a huge shift. So he's giving a little more history than you probably would normally give in a paper like this. The stock moved very negatively. So one thing I'd like to see here more is more discussion of the actual report. That would really help. So he's given a lot of history. So I probably want to see. I can't go back to the previous page, but it probably help. So here he does have that 33, number of subscribers. If you're doing something like this, you definitely want to talk about subscribers. That's a huge part. I'm not sure exactly how many levels of rates they have. It'd be interesting to see. So, however, despite the outstanding report, the stock moved very negatively after earnings calls up to what investors would expect after reporting such strong numbers. So now he's got to explain that. So the stock was down 13.67%. So I need to see at least the closing price of the stock and at least a graphic of what the stock did. You can do the one I gave you, or you can create your own. In context, the greater market falling graph below compares how S&P, how it did versus the market. So he created his own graph here. So why did Adobe? So he's going to explain it. Below is a table comparing reported. Not sure exactly what it did here, but the forecast by Adobe that are unsatisfactory compared to analyst projecting impact to the stock price. So he's somewhat blaming on management outlook. You've seen that a lot here. We were looking this morning at a dashboard meeting. Two stocks, Intel and LW, crashed because of earnings report. One stock crashed even without an earnings report, just because management came out and said, hey, our sales numbers aren't looking good. So management can say something even with a good report that negatively impacts the market. Usually on something like this or Netflix, they're talking, this report comes out, they're looking and saying, hey, this next quarter is not looking good. We're not getting as many sales, or we're losing customers or whatever. Big deal with Disney this last week, right? Last couple of weeks, Disney, Iger survived the challenge. They're trying to get their streaming to be profitable. It's still losing money, but it's somewhat turning the corner. There's a lot going on with Disney. For Disney, they're probably more focused on what management's saying and do they believe it or not. Zuckerberg did that with Meta. Meta got crushed. Zuckerberg saying, hey, I learned my lesson. We're going to not be so aggressive on this, whatever visual, whatever thing he's doing. I forget the name of it. Virtual reality, we're going to cut costs. We're going to get back to our core. And then the stock zoomed even before the earnings started reflecting that, just because the market bought into what they were saying. Be a good place for a quote here from management. I don't know who this quote is from, but this is from Bloomberg analyst. I can be strong as well. So, adoption for follow-up is stronger than ever. Active users, another metric management. So he's giving some discussion. I'm not reading this as close as I will. He's going to bring it up at the end. What's next for Adobe? You can do that. Or you could say what I think is most important here, or probably what your boss mainly wants is what should we be looking for here? That's somewhat what he's saying here. What's next? So you as a stockholder, you just talked about report. If your conclusion is the market overreacted, then you may just say, hey, we may want to look at buying this stock. But if the market overreacts, what does the market need to see so they bounce back? So what do we need to be looking for? Is it next quarter's earnings? Is it some report before that? So I'm not going to go in detail on his. I can't read it word for word in here. But probably would want a little bit more on the actual report here. The market reaction, it looks like he did a good job there. So it looks like a strong paper. That's probably not the grade he's going to get because I'm going to read it more carefully. But it looks like he covered everything. All right, all the pieces are there. The organization is one thing to always think about, is in the right order. So when do you start setting up the market reaction? Do you start setting up the beginning, or do you start it, or you just jump into the market. The last thing you want to do is start talking about the market without some transition from what you talked about. If the report was positive and the stock market's up, you can start with words like, as expected, with such a strong report, the stock market reacted favorably. If it's negative and the stock market dropped, you can say the same thing, as expected, with such a negative report, the stock market sold off. If it's the opposite, that's when you can say surprisingly, or given management's negative outlook, even with a strong report, the stock market reacted negatively, or surprisingly, the market didn't like this. You're going to have to come up with some reason why the market didn't like it. You can't just say, wow, really strong report. You think the stock market be up, but the stock market was down. You can't just stop there. I mean, what's the obvious question your boss is asking? Well, why did the stock market react negatively? So I don't know, it just did. That's not going to work. You're going to have to come up with something. What do we do in finance if we don't know? Y'all know the term for that? It's called creative writing. You've got to come up with a reason. That's why you're hired. Do you think there's going to be someone writing about why the stock fell when with good reports? Yeah, that's especially a firm as big as Adobe. I imagine this person found some reports. I mean, it's pretty simple. You just go to Google or wherever and say Adobe earnings report. You're just looking for someone to say, so a lot of times you'll see articles, why did Adobe's stock price fall? I mean, that's the one you're looking for, right? Do they know? No. What are they doing? They're doing creative writing as well. Do they know as well? So they're trying to figure it out. You don't really know if 10 million shares traded. All 10 million shares didn't trade for the exact same reason, but you're trying to find some reason. So really, well, you want to find people who know what they're talking about and seeing what they're saying. So this student went to Bloomberg. Bloomberg Intelligence is not a bad place to go. Bloomberg, just going to news and bringing your company, you can often find a really good article. So Bloomberg, especially a firm this big, is almost always going to publish an article the day of the earnings release. Or go to AV and watch a video about it. You have to go back close to the day of the report. So we're still in March here, and this was a February report. So I don't know. You know, you have to kind of just look. That's why I like Bloomberg, because you just go on the Bloomberg, put in the date, put in the company, and then you see all the articles, and there's probably gonna be 30 or 40 of them on that date. All right. Questions on that? So it's due on Friday. I gave y'all some interesting ones. I wish I had put Lululemon in there and Nike in there. Nike's not a bad one. There's some others, but you have to stop at some point. So, all right. No questions on that. Everybody's good. It's not a difficult paper to write. It's kind of I think, a fun one to write, just because you're doing what finance people do. All right. So we want to finish up stock valuation. Before we get into it, let's go back to good old Walmart. We're using Walmart's dividends to value them. We got a really low valuation. So I want to see if we get a different number if we use free cash flow. The nice thing about free cash flow is if you want to value a firm that's not paying dividends, this is the way you can do it. You wouldn't necessarily do it with Walmart, but it might work. I'm going to give you a really, really simple formula, and then when you take Cat Packham's class, he'll give you a better formula. But I'm just going to take cash from operations. I'm going to take out CapEx. I don't like that adjustment because I think it takes out too much. That's going to give me free cash flow. I'm going to get number of shares. So I get free cash flow. And what's Cat Packham going to do? He's going to give you free cash flow for the firm. This is cash flow per share for equity. Why is this for equity? Because I use cash from operations, which is already net of interest expense. So this belongs to the stockholder. Right? So Catapacum, he takes free cash flow for the firm, you value the firm, and then you subtract out the debt. I'm taking cash from operations, which already has interest expense subtracted out. So it's already a stockholder's free cash flow. But just so you don't get confused between classes. So if you go to Capital IQ, they have an investment banker valuation model that does that approach, takes free cash flow for the firm, you value the firm, subtract out debt. That's your traditional investment banking approach. That's the way Catapacum teaches it. But you can do free cash flow for equity just by using this simple formula. So let's go to Walmart. Go to their financials, cash flow statement. So there's their cash from operations, 35,726. Their CapEx can be a little questionable. It's under investing activities. I like to use this net PP&E line, 20,356,000,000. So that gives me a free cash flow of 15,370,000,000. Number of shares, anyone know where to get the number of shares? Go to the income statement. They give it to you down here. Basic average number of shares are diluted, either one, 8108. And so our free cash flow per share comes out at $1.90.
Make sure you get the diluted share.
I did diluted, yeah, if you're gonna trust the accountants. Y'all remember studying that in accounting? It's pretty subjective. It's actually, if it's a huge difference, then you probably need to think about it. I'm not saying either one's right. I mean, this is the given number of shares outstanding. This is all the warrants and management stock option, all that kind of stuff, which you don't know what that is because they may or may not execute them. So it's a pretty, y'all took that in accounting, y'all study that in accounting. It's pretty complex, isn't it? It's one of the more complicated parts of accounting. So yeah, I understand the theory and it makes sense, but the calculations are so convoluted. I don't know if I trust it all that much. So I don't really care. For Walmart, it doesn't make much difference. It's about the same number. So we get a much more massive number here, $1.90. What did we get before for their dividends is only 81 cents. You use $1.90. For dividend zero, you're now going to get a much, much, much higher valuation. It makes a huge difference. Why? Because Walmart's dividends have been creeping up just 1% or less a year, where their earnings are growing much. It's pretty obvious Walmart's free cash flow is larger than their dividends. So you get a huge difference. Does that bother you? Well, how fast is Walmart actually been growing? I meant to get the Capital IQ. I'll have to do that next time. I'll show you all in the video how to get the Capital IQ. Their earnings haven't really grown all that fast the last 10 years. It's been pretty amazingly pathetic. I mean, really, their earnings have barely kept up with inflation. So that 4% is actually a fairly aggressive earnings number for them. But one thing when you value stocks, big differences is pretty common, actually. And you can see with us, whether we use dividends or free cash flow, we got two radically different numbers. That can be true for a lot of companies.
I want to make sure I'm following this. Going back, so last week when you were doing bonds, right? And so now you're doing stock.
Right.
And so all of this information on the left is. Wait, you didn't use Walmart. Who did you use?
This is Walmart. Yeah. Yeah, we're going to go in detail through all these calculations. I'm just introducing the concept. So free cash flow is what dividends should represent. That's the money management could distribute to their stockholders if they wanted to. It's how much they're producing. It's not what they're actually distributing, because dividends are what they actually distribute. What else could they do with free cash flow? They could pay dividends. They could reinvest in the firm. We're subtracting that out as CapEx. What's the third thing they could do? They could buy their stock back. All right. So dividends misses out the stock buyback. So at least with free cash flow, you're getting that piece in. They could just hold it in cash. That's what Apple and Microsoft are doing. That's all free cash flow. That's all cash they could send to their stockholders. That's what the value of the firm is. It's the free. That's what you want management to do: produce free cash flows. You don't necessarily want them to send it all out to the stockholders because they may have better reasons, better purposes for it. But free cash flow is ideally the best way to value a firm. But we'll practice that a little more. But that's just the introduction. So let's look at stocks. So the biggest issue we have with stocks is how fast the company is going to grow. You have to do this on paper 4. It's the biggest part of paper 4. So how fast can a company grow? Well, you start off with your base for all companies is how fast is the economy growing? We've already did that, right? Productivity growth, labor growth, inflation. Y'all remember that? That's going to be between 4 and 6%. Then you think about the industry. Is your industry in a fast-growing industry or a slow-growing industry? That's when I really, really think this whole concept of, I think I'll show y'all this before. I should go to YouTube. Yeah, these are such excellent videos. He has so many videos that are just absolutely for free. Some of them are from like his condo. Some of them are conferences, but this is the one where he's talking about how different industries are in different spots in their cycle. Is it startup? If it's fast growth, is maturing? Is it declining? That's a good way to think about where you are in this cycle. Are you in an industry that's in the early phase, that's expanding? Is it maturing? Is it coming back down?
What's the official name of the chart we have?
I don't know if he has an official name. I don't know if it's like his own creation. It's the life cycle of a corporation. This is revenues, this is earnings, but it's the life cycle of a corporation. The startup, the rapid growth. I don't know if you can even see the titles here. The idea to a business, losing money. I don't know, bar mitzvah meaning, I guess teenager. He tried to compare it to a person's life, right? You're born, you're a kid, you're a toddler, you become a teenager. You start scaling up, middle age, death at the very, very end. Startup, young growth, high growth, mature, stable, decline. You're telling a compelling story, plausible story. I mean, you really should be watching Demoderan. He's just such an excellent professor. And what he's saying here is, what does management have to do here? Here, the key is the story. You got to make it compelling. Yeah, there's growth there. People are going to do this. People are going to buy this. Then you stay consistent with the story. Then you start delivering earnings. And that's one of the things he says about a firm. How early do you have to start producing positive earnings? How long can you go with losses? How long would Mark let you do that? So excellent podcast or video. So that's part of what I'm talking about. Where is this industry? What's the cycle? What's the demographics of it? Demographics is one of the most predictable things we have. So if your product is being sold to 20-year-olds, we know how many 20-year-olds there will be in 10 years. In 20 years, we have a pretty good idea on that. If you're selling Hip replacements. We know how many 60 and 70-year-olds there are. That's a growth market. I was watching Eli Lilly. What are they selling? The weight reduction pill, right? That's their big thing. So The Economist had an article on that. How many people would buy that pill? Yeah, so how many people is that around the world? How many can actually afford that around the world? All right, so that's what he's looking at, trying to figure out that growth rate. How long will it take to get there? The big key is, when does Medicare and health insurance cover it? That's pretty huge, right? They have to have some proof. You're still worried about the side effects. You don't really know. There's people coming up, there's competition coming in. We know Eli Lilly and the other competitor, I can never remember, the non-US company, their stocks are up tremendously because we're talking, $10 billion business there. That's all the things you're doing, but there's a demographic so that we have data on how many people might actually purchase this particular pill. What is it, US versus non-US? Where's the growth there? Those are the kind of things you're looking at. Porter's 5 forces is really, really excellent here. Hopefully y'all have that and you know it, because we use it all the time in finance. But who's the buyers? What's their power? Who's the suppliers? How hard is it to get into this industry? What are threats to this industry that could come along and just wipe it out? How much rivalry is there in this industry? So you look at someone like Adobe, the buyer power is not all that much because it's pretty dispersed. The supplier in this case is essentially Adobe's employees. It's the inventors, it's the software producers. The barriers to entry is pretty high because they've got a dedicated on barriers to entry and buyer power. What do you think is the biggest thing there? Have y'all heard of switching costs? Why do people not want to move from Adobe? If you ever try to learn an entire new software package, I was using I have a music degree, so I'm writing music on a software package. And I got to buy a whole new software package. It's like I can't do anything. It's just impossible. I don't even know how to put an eighth note down. It's just like it's completely new. I don't want to switch. I'll stick with the old one no matter how bad it is, because I want to learn something new. For Adobe, that's huge. You don't have to learn. There may be a better software package out there, but people don't want to switch. That's switching costs. Threats of substitutes. Is there a threat of substitute for something like Adobe? You can't say a new competitor. That's not a threat of a substitute. A substitute is another industry coming in and doing what you're doing. So if you're selling milk, what are you worried about? You're worried about almond milk and all these substitutes. Those are substitutes. If you're selling beef, what are you worried about? Artificial. Yeah, well, chicken could be, that's kind of already out there, but artificial meat. So those threats of subs, and then rivalry within the industry. If the industry is fighting for market share, that's horrible. When does an industry not fight for market share? When the market's growing fast. But when you've hit the end of the market and there's no more market growth, and you're fighting for market share. So Porter's 5 forces is excellent way to think about growth. He also talks about the strategies of cost leader and differentiation. I like to think a lot about differentiation. How does a firm differentiate itself? Is it marketing? Is it the product? Is it services? Is it location? How do they differentiate themselves? And another way you can think about this is economic moats. That's what I talk about with Adobe. Is switching costs is a huge economic moat for them. So does your industry have economic moats? Does your company have economic moats? So think about your industry, and then you get down to the company itself. Here's where economic moats is extremely important. What does your firm have that protects it from the competition? I should have had this in here, but the term sustainable competitive advantage, have you heard that before? Sustainable competitive advantage. Wow, my firm has really high returns. Well, you have really high returns. What does that attract? Competition. What does this firm have that's going to keep the competition away? Those are the kind of ways you're going to think about it. One of my favorite ways of looking at this is, again, Porter is so amazing. Have y'all done value chains in your class? Y'all heard that? So how many have never heard of value chain? Here, about a fourth of the class. Yeah, I would be reading value chains. So here's the value chains. Does this look familiar? Anybody seen this before? Really, really critically important. So what is Porter saying? A firm over the life cycle of whatever it does is adding value at different points. At some point is where their most important value is added. It can be procurement where they're buying raw materials. It can be operations where they're building a product. It can be marketing where they're advertising to their customer. It can be distribution where they're delivering it to their customer. It can be service after the sale. Where is it that they add the most value? I was listening to HelloFresh, really good podcast. What did he say was their goal? He said they want to be Olympic in every single one of those boxes. Because he said, you might be Olympic here, but if you're an Olympic sprinter and you have a sprain, doesn't matter how good you are, how good your right leg is. He said, HelloFresh has got to be Olympic in every single one of those boxes. They can't just be average. I don't know if that's really true, if you can really be Olympic in all of them. But why did HelloFresh do well and their competition didn't? You know, that's what he's saying. If you got to be perfect in all of these things. I don't know why anybody do it. HelloFresh, it seems incredibly expensive to me versus just going to HEB, but some people like that. But whatever they're doing, they're trying to maximize that. So they're talking about where do you add value along here? Value is what your customer appreciates. And what the customers appreciate, you either saving them time or you're giving them affinity. You're making life easier, or people are impressed because they got your product. All right. That's how you add value. And so you have to figure out how to do that along the chain somewhere in there. So it's a great concept. All of these are ways to think about growth. So Porter is just excellent in this area. His books are that thick and they're really tough to read. I try to read one of his books while riding my bike. It's not the kind of book you read while you're riding a bike, because he goes in incredible detail on every company and every industry. But that, as a finance major, that's what you need. You have to have that level of depth. So these are just ways to think about it, but Porter gives you some excellent ways to think about it. I remember I took Porter, I guess, in graduate school, thinking, well, I'm not in strategy, I'm not in management, I don't have to worry about it. And then in finance, I heard Porter all the time. It was amazing, especially in the investment side. The investment side uses Porter a lot. And I have Porter's book with his autograph, so I'll keep that important book. All right, so when you think about this, you can come up with a growth rate. For most companies, this growth rate down here might be an unusual growth rate for like the next 5-10 years. For most firms, the ultimate growth rate is going to be tied somewhat to the economy, maybe less than the economy because you're in your declining phase. But for most firms, they have a shorter term growth rate and then an ultimate growth rate. The ultimate growth rate, we call that terminal growth. So what about this shorter term growth rate? Can you get any indication on that? And I'm going to give you a few hints that you can use to try to think of some decent numbers. The first one is history. I'll show you this next. I got to get Capital IQ to work, and I can never remember my password. Do y'all use Capital IQ? They've got it working in the FSC. So if you log in FSC, Capital IQ works on all those machines, and I'll show you some really cool stuff you can do with Capital IQ. But Capital IQ brings in historical financials. You can just calculate returns or growth rates on the company itself. So if you think, hey, I think this company could grow 15%, and you look the last 10 years, 5 years, and 3 years, and they've never grown faster than 8%, your boss is probably going to wonder, why do you think they're suddenly going to grow a lot faster than they ever had before? What are you seeing in this firm that suddenly they're going to grow really, really fast? So use historical growth. That's not a bad way to do it. Historical growth of what? Well, probably earnings per share. I like to look at the growth in earnings and the growth in earnings per share. Because if they're buying their stock back, which is going to grow faster? Earnings or earnings per share. They're buying their stock back. So what happens? Earnings per share is going to grow faster. I kind of like to look at that adjustment. But what if their earnings used to be negative? You can't do a growth rate if your first number is negative. What if their first number was 1 cent because of a recession and now it's $4? That's going to give you a ridiculous growth number. So that's the problem with growth rates, is you're really sensitive to that starting number. So you may not be able to do this with some companies because they had negative growth. I mentioned Duolingo. You can't really do this with Duolingo because they don't have any history. So it wouldn't be a good firm to do, but a firm like Walmart, pretty simple. They've had positive earnings forever. You can do growth rates, 10 years, 3 years, whatever. The second one I call the peg ratio approach, which is what does the market thinks their growth rate is going to be? So we're going to talk about PE ratios here pretty soon, but a PE ratio is your price divided by your earnings per share. It's essentially how much you're paying for $1 earnings. The PEG ratio is the PE ratio divided by what the market thinks earnings growth is going to be over the next 5 years. Which means if you take the PE ratio and divide it by the PEG ratio, you know what the market thinks growth is going to be over the next 5 years. Now that's somebody else's opinion, but that's not a bad thing to do. At least have some sense of what the market thinks. So with Walmart, if you go to statistics, which PE ratio would you use, do you think? Trailing or forward? Forward, yeah, definitely use forward because we're talking about their PE over the next year's earnings. Their forward PE is 2336. In their PEG, 2336. Did I say 46? In their PEG, I don't like using the current because sometimes the quarterly numbers get messed up. So I use the latest year. Their PEG ratio, see what it says? 5-year expected, 2.89. So the expected growth Bill Gates. It's just PE divided by the PEG. You get a really high growth rate, 8%. Why would they think Walmart's so strong? I think part of it is because they're maybe coming off a low number. You'd have to look at the earnings per share to see. So they've had, they did really well coming out of COVID, and then they had some kind of weak numbers. 8% seems really high for me for Walmart. I wouldn't use an 8%, but that's not going to be your long-term growth rate. So this is a short-term rate, short-term growth, which means you need two things. You need a short-term growth rate. What else might you need? You might need something on timing. Is that 8% over the next, this is the next 5 years, but you're going to have to decide, is they're going to grow 8% for 10 years, for 20 years, for 2 years, for 30 years? You have to decide on that. Let's try a firm like NVIDIA. What do you think they're going to have? High growth, low growth? How high? More than 10%?
Yeah.
So their forward PE is 30.4. Their PEG ratio is 0.6, which is kind of ridiculous. Their short-term growth rate is 51%. That's pretty crazy. Now, there are PEG ratio groupies out there that think that PEG ratio is the only thing you need to buy a stock, and they'll say you need a PEG ratio below 1. I don't believe that. That PEG ratio is below 1 makes sense because PE ratios move with interest rates and inflation, so it doesn't make sense. The PEG ratio below 1 would make sense. But NVIDIA's PEG ratio, you normally think a firm like NVIDIA would have a really high PEG ratio, but their expected growth is so massive that their PEG ratio is actually low. What about Lilly? What would you expect? Lower than high, but lower. All right, let's see. So there are 4 PE, 47.62. Their PEG 143, so it can be much lower, but still pretty high, 33% growth. That's a really, really high growth rate. What about Campbell Soup? How many are running out to buy Campbell Soup and you never bought it before in your life? It gets cold, maybe during COVID, people were doing that. It's a really cheap way to feed a family. Pretty cheap stock, 14.56. PEG ratio, 164. Growth rate, again, 8%. So that seems awfully high as well. Maybe they have international growth or whatever, but that's what the market's projecting. I wish I could find a negative firm. It'd be interesting. Some firms I can't do because they don't have PE ratios because they don't have earnings. So a firm like JCPenney or someone that's really struggling, you may not be able to do that. But that is a perfectly reasonable approach to get a ballpark number, but it's somebody else's number. Your boss isn't hiring you to use other people's numbers.
What about like regression?
Regress, well, you can always regress history, but you know, it's if you want to just interpolate that out, unless you're I mean, you're gonna regress what, just the historical growth?
Yeah, like you think like your Y could be like what the stock goes at, and then your dependent be, over weeks or months and compare it to that.
I mean, it's possible. I don't know anyone that's that use that for growth. We're gonna use that for beta, obviously. I don't know. You have to figure out what your dependent and independent variables are, because it's I mean, if you're suggesting the stock price itself produces a prediction of growth, that's kind of what the PE ratio is doing as well. But I mean, I don't know. You can try it, see what data you have to input. All right, so there's the second approach. That one gives you somebody else's opinion. Where else could you go for this? Other people's opinions. One other place you can go is in Bloomberg. They have something called EE, which is earnings estimates. If you go on the Bloomberg and type in your company, so if we're doing NVIDIA, maybe I should show you a page like this. NVIDIA, then you do the function 8, say it's a stock, and then you type EE. Bloomberg will tell you people's forecasts for earnings growth, revenue growth, all kinds of stuff. So you can use that as well. It might be different what the PEG ratio is saying, because there are different people with different projections. So that's another approach to get other people's projections on what earnings growth is going to be. Make sure when you do this that you change it to annual, not quarterly, because you really want to see more years out there. You have to be a little tricky. It can be a little, especially for smaller firms, you got to be real careful. How many forecasters are there? So you might have 6 people forecasting 1 year out, 4 2 years out, and like 1 person 5 years out. And using one person's forecast, that's like, who is this person? It's like, well, I don't know. They must be pretty good at their forecast, but who knows? It could be someone who doesn't have a clue what they're doing. So you got to be careful. How many forecasters are there? There's probably going to be more for NVIDIA than there are for some startup firm. But that's another approach that you can actually get somebody else's forecast for your company's earnings growth. And the nice thing about Bloomberg is they also give you revenue growth, which is kind of nice. They may even give you gross margin, some other things you can look at. And they give you nice little cool graphs that you can use as well. All right. Third approach is the textbooks. And that's what we call sustainable growth. You probably had this in 3013, but just to refresh your memory. How fast can a firm grow without having to go out and get capital from the market? And sustainable growth is return on equity times retention. That's the definition of sustainable growth. Retention is 1 minus your payout. So if your dividends per share is $1.59 and your earnings per share is $4.74, then you're retaining $3.15. And the theory says if you're paying a dividend, you can't grow. You make $6 and you pay $6, you can't grow because you have nothing to grow with. You're just, distributing out the entire firm. So you can only grow with retention. So ROE times retention gives you your sustainable growth. There's a big problem with this, but we'll calculate it anyway. So you get ROE, you get the payout, that gives you retention, and then you get sustainable growth. So for Walmart, let's go back to Walmart. So I go up to statistics, and we find return on equity, which they keep moving it, but it's in here somewhere. There it is, return on equity, 18.64%. The payout is 39.79. I'm just going to say 40%. What's their retention? You pay out 40%, how much are you retaining? 60%. So what's their sustainable growth? 11%. What's the problem with this number? It's this right here. You want to normalize this. And I'll show you when I remember to bring capital IQ in, I'll show you how to normalize it. What if that 18.64% was the highest number they've had in 20 years and our normal's been 8%? Or what if the normal's been 18% and last year was negative 9%? What can you do? Well, one thing you could do, which is pretty good, is just do the median last 5 years. That's not a bad way. Why median, not average? What's the problem with averages?
One number is like super high.
Yeah, outliers really mess up averages. So the median the last 5 years, that kind of takes those extremes out. So that's a good way to normalize it. You could say the same thing with payout and retention. So if you do Costco, where they have these massive payouts every 5 years, you have to say, well, what is that payout? Do I somehow normalize that? So they pay a $1 dividend most years, but then they pay $10 every once in a year. You may kind of say, what is the average over a 10-year period for their payout? So you may want to normalize this. But pretty simple formula. Does this work in practice? Good old Randy Arnott actually studied this, because the implications of this is that firms that retain more will grow faster than firms who don't retain more. So he went out and did a regression on retention rates and growth rates, and guess what he found? Firms that retain more grow more slowly than firms that pay out more. He found the exact opposite. Does that mean this theory is wrong? I don't think it does. I don't think it misproves the theory. I think what it is it's a timing issue for him. So in 2008, what were firms doing? Paying out more or retaining more? Retaining more. Why were they retaining more? Is because they had great growth prospects? No, they were scared to death. So firms tend to retain during a crisis because they're scared to death. When do they pay out more? When they're really confident and things are going well. So I think in the long term, it's true. If you retain more, you'll grow faster. But in the short term, when you're there's a lot of noise with prices and such, it can give you some really bad numbers. So yeah, the actual empirical data says it's the exact opposite, but I think the theory is true, and you can get something out of the theory. His name of his article is Surprise Higher Payouts Mean Higher Growth. And it was like made a big splash. And then you got the timing. Here's where your creative writing is going to be the biggest in paper 4. How far out do you go? And you just got to figure out some way to say, so far, Lily, how far out do you go? I can get that. Well, you might look in historically another drug that had a big splash. See how long did it take for that to saturate its market? I don't know what the big drugs are we've had in the last 50 years. So who knows? So how long is it going to take to get from that near-term growth to terminal growth? What about NVIDIA? You get AI, you got an AI adoption, those kind of things. You might look at a previous technology that really took off like that and say, how long did it take? I don't know. It's really, really tough. Are y'all familiar with the S curve? Does that sound familiar? Yeah. Not in project management, but so a few years ago, everybody was talking about AI, how it's going to take over the world, and what happened? Nothing. That's the typical S curve, right? All these expectations, nothing's happened, and then suddenly it happens. So we're expecting break growth. That's kind of what people thought happened in 2000. All the .com people were like, this massive growth. The market got way ahead of itself, but was the market wrong? No, it was actually right. It was just 10 years too early. Exactly what they thought was going to happen was going to happen. It just happened too late. That's somewhat the S curve. So we had the big hype on AI and nothing happened. Now we have the second hype. Is the second hype that shot up in the S curve, or are we going to have a third hype? Who knows? That's kind of what you have to answer. Same thing with Lilly and the weight loss drug. Is it hype? And is it going to take off or not? One thing that really, really helps, a concept that I would think about, is this idea of catalyst. I mentioned it on AI. So right now, AI, who's making money on AI? People selling AI. Who's not making money on AI? The people using it in their firm. You've got to get the catalyst such that people are making money. So when does Fiesta, Texas start making money on AI? Can it be new rides? I've been really shocked on, so I went to Disney, oh my word, before you guys were born. They had this wonderful Star Wars ride. It was all alternative reality. I thought it was the coolest thing. I felt like it probably seemed really crude today. When I was a kid, we used to go to the Six Flags and they had the big screen. You watch the screen, you felt like you're on the roller coaster. That would be so stupid today. I don't know if y'all saw the first time a motion picture was shown and the people screamed or ran out of the room because they thought a train was going to hit them. I mean, our brains expect so much more. So that ride would probably be pretty simplistic now. But I didn't know why theme parks didn't do that. That seems a lot cheaper than building a new roller coaster, doesn't it? It seems like you could take the exact same software and just change the vehicle. Instead of it being Star Wars, now you're on a whatever, but that hasn't taken off.
They built stuff like that for flight simulators, but it's really complicated and expensive, especially because like you can only really have a limited number of passengers, so there's other like efficiency issues. And like,
well, this one had a good 20 people in the room.
Oh, you mean like there's like a?
And I've seen them at malls. Yeah, I've seen them at malls. I mean, it seemed like we were there. To me, it was a lot more fun than a roller coaster. And I'm 60 years old, so I wasn't going to break any bones. So I like that a lot more. And plus, when you turn 60, your stomach doesn't work as well. But that was 20 something years ago. I thought, wow, that's really cool. It didn't take off. So I don't know. AI, to me, when is it going to take off? I really look forward to going on Netflix and saying, I want to watch a rerun of Friends, but I want Monica to be played by Lucille Ball. I want Ross to be played by John Wayne. Couldn't the AI do that? Would you pay more for something like that? It'd be pretty cool. Or would that get really old really fast? So who knows? But that's the catalyst. Someone's got to invent something so people start buying this product. Right now, it's just the people making the AI that's causing it. Who knows? We got the same thing with electronic vehicles. What's going to change that? Price is going to come down. Government's got to, who knows? So you have to have a catalyst, and that's why the S curve is there. Because the people that are inventing it are really excited. This is really wonderful, but the people buying it, they're like, I can't afford that yet. How much does the Meta thing cost?
The medical?
Yeah.
It's
500.
Too much, right? Are y'all buying that thing?
Yeah.
It's a little expensive, and that's something I'll worry about that might get old after a few months, that you're like, yeah, it's kind of cool, but I'm not going to do anything. So you got to think, and that's where you as an analyst, it's so important. When is this thing suddenly going to take off? What's going to cause people to start doing this thing that they're going to spend money on? So you have the story, which is real excited. Founders are they can get people really excited about the product, but you have to get people actually buying it and using it, and other people using it. So you have the early adopters, but you got to get it so that everybody's using it. So that's going to influence that timing of your growth rates. Dan and Darren, I'd agree with them. 10 years is a long time for really high growth. If you go back and look at the biggest firms today, the Microsofts of the world, yeah, they had 9, 10, 11 years with those 30, 40% growth rates. And you say, well, look at them, but we're talking 10 firms out of 10,000. It doesn't happen that often. It's really hard to grow 30, 40% for a decade or more, because you just get so massive. I mean, think about Apple today, a $2-3 trillion company. You can have a new product that really takes off, but you got all these existing products that are growing 3-4%. That new product growing 50%, you hardly even notice it with the rest of the company. It's hard to make a $3 trillion company grow 10, 20%. So we usually are too optimistic, too big in our projections going out. So your terminal growth is probably going to be tied to the economy. Your short-term growth and the timing is going to be entirely up to you and very subjective what you think. I gave you 3 approaches to try to get some ballpark on it, but who knows? I mean, you look at NVIDIA, we're mentioning NVIDIA. Wow, we're talking about short-term growth rates. I mean, it is pretty shocking, isn't it? To look at a firm that went from revenues of 26 billion to 61 billion in 1 year. How many firms have you seen grow the revenues like that in a year? Can you think of an example? I mean, maybe you saw 100 million going to 700 million, some new startup firm, but we're talking about a massive firm here doubling their revenue in 1 year. That is incredible. Can they do that again? That'd be pretty tough, wouldn't it?
What do you think about, I'm just kidding, what do you think about Tesla this past quarter? Do you think they're still going to be considered?
Well, they're back to they can't produce the cars, so why is the world not buying EVs? Their growth rate's pretty massive. It's pretty impressive. But why is the world stop buying EVs? They fell to second place, and I think they're back up to first place again. So it's between them and China. China may have a bigger story. If you're going to force people in California to buy EVs, you're going to need those $20,000 cars from China to make it work. But yeah, so how would you do this? How many cars are there in the world? How many are gas? How many are electric? What percentage will EV be each year in the next 20 years out? That's the kind of thing you're going to do to try to figure out what market share will Tesla have. That's all the kind of math you're going to do to try to figure that out. It's a pretty tough equation to figure out. But he's got to produce the cars, right? He can't keep struggling with just basic production. All right, so we'll talk, when we do the example, we'll talk about this more. It is tough. Growth rates are really, really tough. And the reason it's really frustrating is a small change in your growth rate has a massive impact on your valuations. So your valuations are very, very sensitive to what growth rate you pick, but you got to pick a growth rate and go with it. All right, so let's talk about where we're going to go here. So papers 3 and 4. So paper 3, you need a discount rate. We call it KE. What is KE? Cost of equity capital. Paper 4, you need a valuation, which is going to be driven off of growth rates. So to get a KE, what theory do you think we'll use in paper 3? What model might we use? CAPM, oh, no question. What does CAPM say KE is? Y'all have this memorized backwards and forwards, right? Risk-free rate. Market risk premium, or if you're doing the fact exam, required return on stocks minus risk-free rate. All right, so we need the risk-free rate. We need the market risk premium. We need beta. So paper 3 is a matter of getting these 3 numbers. The first number has gotten really, really easy. 3 years ago, it was a problem because 3 years ago, this number was 0.5%. So you had to have a whole discussion. Can I really use 0.5% as my risk-free rate? You don't have that problem anymore. You just go out and get 10-year treasury. You might put a graph in of it just to say, hey, the 10-year treasury is back to more normal level. So I'm just going to use a 10-year treasury, but usually this is one paragraph, maybe one graph. So that's pretty straightforward. The market risk premium, we are going to use the implied approach. The most popular approach. I gave you an article. You don't necessarily have to read it, but I did give you an article. But the most famous article on this, it was written over a decade ago, 2 decades ago. So they changed the world. Before they wrote this article, the most common approach was the historical approach. That's good old Dr. Ibbotson. So it used to be Dr. Ibbotson, Roger Ibbotson, Chicago School. He's retired. I've met him a couple of times. Really very smart man. So he did the historical approach. But Barclays wrote this article, and suddenly we over at USAA overnight we went to the implied approach. It just makes, I think it's much more theoretically accurate. But we'll talk about these 2 approaches. There are other approaches out there. I have a document that JP Morgan produced where they showed all of the approaches to market risk premium. Very interesting article. I've got a photocopy of it. It says do not copy, copyright protected. So I emailed the writers and said, can I share this with my students? And I still have the email. He said, sure, we don't care. But that's a good one as well. There's others of them. There's the VIX approach. There's the bond spread approach. There's the even discount model approach, which I don't think works at all. There's all these other approaches. I think today almost everybody uses the implied approach. All right, so that's what we want to use in the paper. And then beta, I'm going to show you 4 steps you must use. So we're going to use my 4 steps. So that essentially is your paper 3. 10-year treasury is easy. The implied approach, I'll talk about the inputs to that, how you get that market risk premium. If you want to get other sources for the market risk premium, then you just do Dan or Darren market. I think he calls it equity risk premium. And he's got all kinds of free stuff. Implied ERP by month for previous months. There he is. He uses the implied approach. And there's his market risk premium, that red right there. ERP. He calls it equity risk premium. It's the same thing. Market risk premium, equity risk premium are the exact same thing. And there's the risk-free rate. See how low it was back in 2022 as it was rising up. So for paper 4, what do you need? Well, you need some obvious things. You need dividend 0 or free cash flow 0. You need your KE from paper 3. You need a long-term growth or terminal growth. You need short-term growth. You need your timing. And because I'm going to give you one extra model, you also need earnings per share 0. You need those, that's your input. So your paper 4 is coming up with those numbers. All right. So that's the 2 papers. So we probably won't do it next class because I want to show you relative value analysis first. But then we'll come back and do this. So what I'll do in class is actually do this for Walmart step by step by step. So you have it in the video and you can do your own company, but start thinking about what company you want to use for this project. You could use the same company you did for paper 2, but you don't have to. So, all right, I'll stop it there. So this is our blog from our dashboard meeting. I hope some of y'all have started doing this. I just sent it to an investor in New York today. He called me saying small world, all these people he knew that I knew. And he's like, I'd say, well, I'll send you the blog we do. So what was the big issue? We said March CPI is the big thing to watch this month, this week. Last week, it was a jobs report. The jobs report came out strong. It wasn't like a blowout, but it came out strong. The market, kind of hard to say how it reacted to that. It hasn't been positive for markets. And so we said that's the thing to watch out for. And sure enough, today, how did CPI come out? Worse than expected, higher than expected. And what does stock market do? Large cap sold off, but look at small cap. Sold off 2.52%, and small cap value was off 3% today. That's why I keep saying I'm doing small cap value, so it's painful. But when the Fed cuts rates, boy, small cap value is just going to take off. So it's that kind of inevitable thing. And how did bonds do today? What kind of day is that? Pretty bad day, right? How many sigma is that? Over 3 sigma again. That's a pretty horrible day. Gold should be up today because of inflation, but gold is down. Why do you think gold is down? The dollar is up. Why is the dollar up? Because interest rates are up, right? The dollar should be weak with inflation, but the dollar is strong with interest rates. You have to say which of those is the bigger push. But oil prices, are flat. Well, I guess they are up. They were down yesterday. Oil prices is part of the headache for the Fed because they have been rising this year, going from $70 up to $86. That's a pretty big jump. That's not in the numbers yet on CPIs, because if you look at core CPI, it's still much lower than headline CPI. Core CPI takes energy out, so it's still lower. So, I'm sorry. Headline CPI is lower than core, so energy is actually keeping headline CPI down, but now energy is going up, so we may see a big reversal. So it's a pretty rough day today for markets unless you're buying oil. What else is up today? Y'all see any red numbers? Blue numbers? Bitcoin's up today. Japan's down again. Japan, remember they hit that record 40,000 something? $41,000, and now they're back down to 39. So, it's not been a great year. Everybody was so happy in December, and now they're not. And then we talked in the post, which I think is really interesting, is GE. GE is they were the company that everybody hated. They're going out of business. Just nothing is right. And then now they're just soaring. And why are they soaring? Because they're spinning off all these businesses, which Wall Street loves. GE was a conglomerate. Wall Street hates conglomerates because they're so hard to analyze. It's hard to analyze a firm that does 80 things. And when you spin them off, boy, people love it. Valero did the same thing. Valero spun off corner stores and made it a much easier firm to analyze. You get a benefit for that. So GE's up over 200% the last 2 years versus the S&P only up 38%. So GE's doing great. How many of y'all bought GE 2 years ago? Y'all doing that? If you done it and said it in an interview, they think, man, you don't know what's going on. GE's an old school dying company. Now they have some headwinds, definitely. They're making jet engines for a firm named Boeing, which doesn't sound all that great either, does it? Boeing's not been doing great, but so interesting day in the markets. If you interview today, you would absolutely want to know that large cap was down. I would bring up the small cap. I would definitely be bringing up the 10-year treasury. And all of this is tied to the inflation report. So if you went into an interview today and didn't know any of that, you'd be in a lot of trouble. So, so that's why you see why we do this. We do this blog. Students doing this blog, when they walk into an interview, it's going to be off the top of their head. They're going to know exactly what to say. Not you have to join our group, but start your own dashboard. I just talked to a guy, the guy I talked to from New York says, oh, my son's going to start college at Rice next year. And I say he should do a dashboard every week. So, oh yeah, that's great. We have to do that. So I highly, highly recommend it. All right. So today we're going to price some bonds. All right. So let's look at this. They look pretty bad, as I was expecting. This is a chance for our team to really jump in the first place if you just come prepared for this, because you have to get prepared for it on the exam anyway. You might as well. So, all right. So Bill Gates says present value, the rate is what? So it's the 2-year plus what? How much is the spread? So it's 2 years. What's it rating?
80.
So 48. What is 48? 0.48, 0.048, 0.0048, 0.00048, 0048, right? And we have to divide that by 2, right? So number of periods is what? It's 2 years, but how many periods? 4, right on the fact it's 2 because they only do annual coupons. What's the payment here? The coupon 6%, so the payment is what? 30. And then the future value? $1,000. Are you expecting a number of above 1,000, below 1,000? It's paying 6%, and your yield is 508. So it's paying 6 in a market that's only paying 508. So you're expecting more than 1,000 or less than 1,000. It should be a premium bond. All right, that sounds pretty good. The estimate, I'm going to say the duration. It's somewhere between 1.8 and 1.9. I'll use 1.9. So you do minus duration times and change in yield. So yields are today 0.046, 0.0048, and they were 0.06. So interest rates have fallen. So minus duration is going to give us a positive number. We'll multiply that by $1,000. It gives us another estimate. So I'm feeling pretty good so far. I don't know why it's Bill Gates does that, but on the exam, you have to do the table. So why am I so picky? Because as a finance major professional, you got to know what the formulas are doing. You can't rely on Bill Gates for everything. You got to actually know what the formulas are doing. So what is the formula doing? So we've got time, we got a cash flow. We're going to discount it. And you have a discounted cash flow. To do this, we got to get the rate. So the rate's going to be 0.046, the two-year treasury plus 0.0048. So there's our discount rate, but it's twice a year. So we got to do the effective yield. 1 plus that divided by 2. raise it a second -1. So we'll get a cash flow in a month, in a year, I mean, in 6 months, in 18 months, and in 2 years, our cash flow is 30. The factor is 1 divided by, this y'all do all the time, right? This is what a finance major does. 1 plus the effective yield, raise the time. And then our DCF, we just multiply across. Let's see if the table agrees. Y'all think it'll be the same? Nope, I did something wrong. What did I do wrong? Yeah, so I got that. But I made a mistake somewhere. Don't know where I made it. Ah. Actually, it said plus instead of times, so I just hit the wrong key. Is that closer? It looks pretty good, doesn't it? What is a duration? So you should know. You should know the formula for duration. You don't need another formula for convexity, but duration, real simple. You just say, okay, there's the cash flow. So it's time to maturity multiplied by the weight, which is going to be each discounted cash flow divided by the total. And so duration, let's see how close I got on duration. Oh, I'm way off because the last one's already 1.8. So wow, it's actually over 1.9. I'm surprised with interest rate as high as that. So if I use 1.9, I get much closer there on the estimate. Right? You should be able to do this in your sleep. This is like 3013, right? This introductory, just understanding the basics of finance, bonds, just real straightforward. So again, the fact exam will only give an annual coupon, makes it a lot simpler, but it's very unrealistic. No, there's very few bonds that pay once a year. Questions on that? Anybody get, I don't think I saw any 1017s on anybody's. I saw some, they didn't get the table at least that far. And then y'all stopped. Can you post this? I guess eventually, yeah, this is a really messy spreadsheet.
Honestly, you can do it anyways, it's really the formulas.
Huh?
You can just do it anyways, really just do the formulas, make sure.
Yeah, I don't know where I am here.
It's sheet 10.
10. So yeah, it's just a really messy spreadsheet. All right, well, I'll see. I'll try to put something out there. I'm assuming y'all done this like 80,000 times already as a sophomore, junior finance major. I've done it a few million times in my life. Because this kind of cash flows, we do it all the time. You got to understand what a bond is. And this is finance. This is just the straightforward part of finance. The value in a bond, just real straightforward stuff. All right. So today what I want to do is I want to do the stock valuation for papers 3 and 4, but I'm going to wait to do that next week so you can get paper 2 turned in. So I want to do stock valuation, but look at relative value. And so then next week, we'll walk through the whole process of your paper 3 and 4. So today or yesterday, I got an email from a student that took this class a couple years ago. And she goes, "Oh, professor, remember that paper 3, 4 that we did in your class? I put that on LinkedIn, and then that was my entire interview was about that paper." So I assure you, these papers are a huge advantage. Very few students write papers anymore, and paper 3 and 4 especially, it's a perfect paper to put on LinkedIn. Because you're doing an entire financial process in there, so it's perfect. So we'll do that next week. I'll do it on Walmart, which means you can't do Walmart for your paper. So let's do relative value analysis. I don't think anyone in here took my 3013 class thing. Oh, you did. So you're going to see this again. Do you want to teach this part? Do you remember it? All right. So relative value analysis. extremely important to understand. I thought it was interesting listening to Dr. Demoteran's class. He said he used not to teach this at all. Because he would ask his students, how many of you are going to do what we're doing on paper 3 and 4? Discounted cash flows, dividend discount models. And they all raise their hand, that's what we're going to do. Says, that's fine. I don't need to teach you relative value analysis. No one does that. Then he decided one day to go out and talk to his students that graduated 5 years earlier. And he asked, how many of you are doing what we did in paper, we're doing in paper 3 and 4? And he said, none of them were. Guess what they were doing? Relative value analysis. So he said, well, I guess I better start teaching relative value analysis if everybody's doing it. And you will see this a lot. What he discovered is some students said, yeah, we do discounted cash flows like y'all are going to do on papers 3 and 4. But then when he looked at it, he discovered what they were doing was discounted cash flows for 5 years, but the terminal year was all relative value analysis. So it was 98% of the valuation was relative value analysis. If you want to apply for a job as an investment banker, there's a model I can show you. Capital IQ has a perfect investment banker model that does the traditional approach, which you go out 5 years. At the end of 5 years, you get relative value analysis, you discount all that. That's the traditional investment banking approach. That is not discounted cash flows. That is relative value analysis. Because almost all of your value, you say, okay, they'll pay a dividend at $1, then $1.20, $1.35, and then in 5 years, their PE ratio should be 18. I'll take their PE ratio times in earnings. The stock's worth that, you present value that 90-something% of the value is going to be in that relative value. So the Motoran says, even if people saying they're doing discounted cash flows aren't even really doing that. All right, so let's look at how relative value falls into the common approach we use for evaluation. There's 3 ways we do this. Relative value is one of those. I'm going to then give you an example of real estate because real estate is a perfect place for relative value. You all probably all use relative value analysis looking at real estate. And then I like what the Motoran said because I stole some of his stuff in this presentation. He says, okay, fine, you're going to do relative value analysis. Let's at least do it correctly. You're going to do relative value analysis, make sure you're doing it with the right type of statistics. So he says, all right, what is good relative value analysis? What's bad relative analysis? What are the most common relatives? Now, I'm going to give you 4 that are kind of industry agnostic. When you get into industries, specific industries have their really specific relative values. So you'll see what those are as you work in those industries. And then we'll get the industry linkages. When do you use the price to earnings? When you do EV to sales, when you do EV to EBITDA, when you do price to book, we need to understand those. That's the actual exam question I give you. And then I'll show you how to do this. I would recommend you do this yourself in Bloomberg. So if you want to do this, my YouTube channel shows you how to do it. The best one on my Bloomberg channel is the aerospace one. You can follow that and build your own model. You can build one pretty quickly. If you take my secure analysis class, that's one of the papers you have to do is to build a model and do that analysis. So it's really powerful to be able to do that because it's an approach that works. It may not be the most sophisticated, but if you start in a job and they're like doing analysis, you can say, I'll just do that. I did it at UTSA. So it's not a bad approach. All right, so there's 3 ways we do valuation. We can do this at the asset level. So if you're trying to figure out large cap growth versus large cap value, you can do these 3 approaches. And you can do it at the security level. You're trying to figure out Apple versus Amazon, you can do it at that level. So paper 3 and 4 is fundamental analysis. My secure analysis class is predominantly fundamental analysis. It's discounted cash flows, it's growth rates, it's discount rates. We're not going to do technical analysis in this class. That's charting and looking at breakouts and trends and support levels. I have one paper in my secure analysis class. They have to do technical analysis. It's the easiest paper in that class. I just want them to be exposed to that. Most commercials you see are technical analysis. All those people selling software, they're selling technical analysis. And then relative value analysis is what we're going to look at. So you can use all 3 of these at the asset level and at the security level. So what is relative value analysis? You're taking some measure of value, a price usually, and comparing to some fundamental factor like earnings or revenue, right? In real estate, we'll see how we do that in real estate. That's what relative value is. And for stocks, we have two measures of value, price and enterprise value. Anybody remember what enterprise value is? So
Isn't that the value of how much the stock is giving you?
well, the stock is the price.
Mhm.
Enterprise value includes something in addition to the price,
The dividend?
not the dividend. The dividend is part of the price. So who owns the price? Stock price. That belongs to stockholders. Who else is interested in this firm's performance? Who?
Credit.
Creditors, the bondholders. What do you think enterprise value is? It's the value of the stock plus the value of the debt. Okay. Can that number be lower than the stock value? So let's look at, I don't know why I shut down Yahoo Finance. So let's look at Walmart. You have to go to statistics. They don't put it on the first page. So there's the market cap. That's the stock. There's the enterprise value. Notice how it's larger because you're adding the debt to the stock amount. Do you think it's possible for enterprise value to be less than market cap? You wouldn't think so, except for what? There's one adjustment we make. So let's look at Microsoft. What do you notice with Microsoft? Enterprise value is lower. How is that possible? Any guesses? What adjustment do they make? Not taxes. What does Microsoft have? A whole lot of cash. Enterprise value, the way they calculate it is the stock value plus the debt minus cash. Right? So Microsoft has more cash than they have debt, so their enterprise value is lower. Why is that? Because we assume the value of cash is cash. So we don't need to make that part of our valuation. We just throw that in at the end. Right. So a firm like that, look at it. We're in trillions now, so they're like rounding. They didn't know how to do it in trillions. So they added a T there.
So that's 5 billion.
Huh?
So they have 5 billion in cash pretty much.
Not 5 billion because they do have some debt. If you look at their financials, and it's not exactly accurate here. And the reason it's not accurate is they're only counting cash. However, they don't have as much here. If you look at Apple, it's even a bigger case. Apple has a lot of cash, no question. 48 billion in cash. However, they have this thing down here called investments. That's cash too. But the enterprise value doesn't count that. So it's an error in enterprise. They should subtract the 120 as well. So what is Apple doing with the 120? Well, instead of putting money in the 3-month T-bills, they're putting it in the 2-year treasuries. They're just parking their cash in longer stock. Well, it moves from cash to investments once you go out further. So it's an error. It's an error in the way they calculate enterprise value. Apple has a whole lot more in investments than Microsoft did. Microsoft, most of theirs was actually saying, right now, you almost, I mean, you're getting making a higher return on cash than you are on 2-year, right? 3-year T-bills or 3-month T-bills are paying 5.4%, 2 years paying like 5 or 4.8. So maybe they should, but Apple has a lot of money out there. I don't think they're going out like 5-10 years. They're probably going out 2 years or so. All right. So that's what enterprise value is. That's real important. Price belongs only to the stockholders. Enterprise value is both stockholders and bondholders, which is going to influence which ratio you're going to use. What are the fundamental factors? There's a bunch of them. Depends on your industry, but the most common one are earnings, revenue, and book value. And earnings, there's several earnings. Net income, EBIT, EBITDA, there's several, we can do that. So who owns book value? Stockholders, bondholders, or both? So book value is assets minus liabilities. So who does that sound like that belongs to? Only stockholders, right? Because you're subtracting out debt. Who owns revenue? So how do you know who owns it? You look on income statement, and if it comes before interest expense, it belongs to both. It comes after interest expense and belongs only to stockholders. Where does revenue come? Before interest expense. So any ratio related revenue, you need to use enterprise value. And in earnings, it just depends on which earnings you're using. Using before interest expense or after. And then there are many industry specific factors. I mean, a good example, UTSA sold their investments to Victory Capital. When you're doing an investment management firm, you're probably going to use a ratio to assets under management. You wouldn't use that for Walmart. It wouldn't make any sense. For assets under management, it's the perfect one to try to figure out what you should value all those. So there's industry specific ones. Utilities have something called regulatory assets. That's specific to utilities. They're going to use that instead of book value. So it depends on your industry. So relative value analysis is not valuing industries. It's not asking, is the stock market overpriced or underpriced? It's just saying one market versus another market or one stock versus another stock, are they relatively overvalued? So every stock could be expensive, but within that, some are all really expensive, some are less expensive. So in an overpriced market, you'd still like to buy the cheaper stocks, even though everything's overpriced. So it's a relative trade. So we're just trying to figure out if something's mispriced relative to something else. And we use these terms that I hate, cheap and rich. Cheap stocks are inexpensive, rich stocks are expensive. What terms did we use on exam 1? We didn't say cheap and rich. We called them what kind of stocks? Value stocks and growth stocks, right? It's a very similar concept. Stocks with low peak price to book ratios are value stocks and they're cheap. Stocks with high price to book ratios are growth stocks and they're expensive. So a very similar concept there. So let's do a real estate example. So I'll call you up and say, I have this house, it's selling for $150,000. You want to buy it? You say, I got some questions. No, I can't answer any questions. I just need to know you want to buy it. Would you buy it? No, you need more information?
Yeah.
All right. So I tell you, okay, well, there's 2 other houses in the neighborhood. They just sold. One sold for $875,000. One sold for $675,000. You want to buy it? Your first question is, what's wrong with the house? Isn't that your first question? It could be in California on the side of a cliff and there's been mudslides. You might say, yeah, that doesn't sound like a good house. So would you buy it with that information? You're a little more tempted, aren't you? But not enough to make you buy. This house could be itty bitty small, and these could be mansions. That's possible, right? They could be in the same neighborhood, but you could have a mix of houses. So let's give you a little more information. Let's say the price per square foot is $75, and these other 2 houses trade for $250 and $225 per square foot. Now we've adjusted for what? The size of the house. And this house looks what? Cheap or rich? Cheap. Really cheap. Would you buy it now? You still know there's something going on with this house, but you're much more tempted now than you were before, aren't you? You might say it's a horrible house, but I could probably tear it down and build another house and make a pretty big profit. Who knows? Price per square foot is a price relative for real estate. So you can compare all the houses to each other. You're dividing something. So if you want to compare a 2,000 square foot house to a 6,000 square foot house, you just do price per square foot. You've got a comparison, right? So that's a price relative. But you probably want more information. It's really key. You need information on value and you need information on risk. You need information on good stuff, information on bad stuff. That's true with stocks as well, right? So on value, what would you want? The size of the house, we've already adjusted that with square feet. Landscaping, the roof. Does it have a pool, number of bedrooms, the kitchen? All these kind of things you might look at related to value. And then on risk, you might ask, is it in a floodplain, which in California is a huge deal. There's like entire cities that are going to shut down because of the floodplain. Does it have foundations issues? When I sold my mom's house, that was the issue. They had a foundation problem. So I had to admit that to the buyer. All these things on stocks, we're going to find a lot more things related to risk, like how much debt do they have, how volatile their earnings. There's a lot of things we can talk about. There are websites out there that collect all kinds of information on houses to try to predict the value of house. So essentially, that's what Zillow does, isn't it? Zillow collects as much information it is, and they try to guess what this house is worth based on that. So let's say, maybe I didn't capture everything, but if we capture everything you think is important and we put it into a regression model, and we, using that regression model, we can explain 91% of the volatility of housing prices looking at 350 houses sold. And based on our model, this house we can get for $75 per square foot should be trading for $150 per square foot. Would you buy the house now? If we captured everything you care about?
Yeah.
Now you probably would. Now you're like, okay, you probably still want to look at the house, but you know, if you got a good model built, that's pretty good. That was a problem with my mom's house. The realtor's like, yeah, they don't build houses like that anymore. People don't like that entry anymore. It's like, yeah, but the person buying is going to look at that. It's hard to capture that in your data, but if we captured everything we possibly could, that's probably pretty good. So yeah, you can buy a house for $75 per square foot that is probably worth $150. Let's say we improve our model. And we ask two more questions. Was anyone murdered in the house? And the house considered haunted? And that gets your R squared up to 98%. That's pretty good, right? And when you do that, your house value comes down to $80. Which tells you something about this house, doesn't it? Something bad happened, right? I still remember that candid camera program where they were showing a house and they put a chalk outline of a dead body in the living room. And the buyers are coming in and the sellers like, oh, ignore that, we'll fix that later. And they're like, wait, no, something happened here. And I know a lady up in Helotes, she brags about her house being haunted. So there are people who think that. I thought she was joking, she wasn't. But yeah, haunted house. So now the house you can buy for 75 and it's worth 80 is not as exciting unless you don't care about these two things. Then the question becomes, how long are you going to live in the house? If you're going to buy this house and you're going to die in this house 80 years later, this is going to be your house forever. You're getting a house for 75 bucks that you think is worth 150. What if you're going to sell the house in a year? Do you care about these things? Yeah. 1 year? You might care. Why might you care? Because the person buying it from you is going to ask what? They're going to ask these two questions. So when you sell it, these become important. That's the exact same thing with Microsoft or Apple and anything else. Your model might say, hey, I don't care about those things. The market thinks they're important, but I don't think they're important. If you're going to be like Warren Buffett and hold Microsoft for 20 years, then yeah, buy it for 75 when it's worth 150. If you're going to sell it a year from now, what market's focused on, you're going to have to worry with that because they're still going to value it at 80 bucks a year from now. So it really depends on your horizon. If there's things the market's focused on that you don't care about, it depends on your horizon. If horizon's long enough, you say, hey, I'll just hold it. This stock's worth 150. That's the Warren Buffett. I don't buy stock as a trader. I buy stock as a business owner. This is a long-term investment. So it just depends on your horizon. So if you plan to live it in 20 years, you can buy a $50 house for 75. If you can sell it in 2, then you're buying an $80 house for 75 because that's what the buyers are going to want. And I've seen the market focus on stuff that I thought was pretty ridiculous. There was a time where they were actually valuing stocks with more debt as more valuable than stocks with less debt. And that like made no sense. Just crazy, but market can get wild. So this is relative value analysis. It's not asking if the housing market's overpriced, underpriced. It's just figuring out if that house you're looking at is well priced. All right, so let's talk about it for stocks. So price relative, it has to be appropriate to the industry. You got to make sure you have the right fundamentals, the right risk factors. You can be generic, but the more specific you can get to your industry, the better. It can get a little tough. If you're doing all retail stocks, you might say, hey, well, there's some factors I think are really, really important, but they only apply to 40% of the companies. Well, that gets a little tough. So you may have to throw that out. If you're only doing airline stocks, there are key price relatives for airlines that work perfectly for airline stocks. They have something called available seat miles. That's a perfect statistic to put in for airlines that you can use for all of it. Revenue per square foot, works for Walmart doesn't work so well for Amazon or Microsoft or other stores, you know, so you're trying your best. The more specific you make your industry, the better your analysis is because you can get really, really specific ratios. All right, so all three have to be there. The right price relative, the right fundamental value, the right measure of risk. If you leave out risk and only look at value, you may find a stock that looks really cheap, but it's not cheap, it's just incredibly risky. You might leave out value, only look at risk, then you might have a stock you think is really, really cheap, but it's not cheap, it's just incredibly risky. Well, other way, you might buy a stock that you think looks cheap, but it's just really slow growth. All right, so your goal is to use your fundamental factors and your risk factors to predict what that relative should be. I mean, you're going to try to find stocks that are trading cheap to that. How many factors do you have? It just depends on your model. Let me show you a model since we're there. Let's see, when's the last time I did one of these? Here's one. 2020, well, here's one, 2023. It won't work in here. Well, I do have it in values. All right, so how many factors do we look at? So we looked at 9 factors here. Some of them are related to value, some are related to growth. We're using these factors to try to figure out what's cheap and what's rich. So there's our model. There's a relationship there. Looks like there is. What stocks do you want? Well, it depends on how I built it. I can't remember which column is which. But one of these columns is whether it's rich or cheap. One of these, the Y, and one of these is whether it's high value or low value. All right. Right here on 1 and 1 would be the most expensive stock and the best stock. Right here would be the cheapest stock and the worst fundamental stock. What you're trying to do is find companies that are not trading where they should trade. And what would you want? A company that's trading cheap that has great fundamentals, or a company that's trading rich that has horrible fundamentals? Pretty cheap with great fundamentals. Do those sit around easy to pick up all the time? No, not very often, right? We consider markets to be pretty efficient, but there is a relationship there, but there are stocks that are way off the model, way off the line. The line is if your model was perfect, everything would just be on that line. The stock you thought was the 4th best would also be the 4th most expensive. All right, so it's a pretty straightforward model. We use Bloomberg to build it. I can't show you the Bloomberg because we don't have the Bloomberg here. So I'm getting the function error, but Bloomberg is a great way to build a model like this because you can bring in, oh my word, how many companies you bring in? 250 companies. We brought in all this data and we ran a regression model to try to figure out who's cheap and who's rich, right? And Larissa, you've done one of these, haven't you, before? You built one? Yeah, so it's really cool to be able to do it. It's pretty simple to do. So that's what we're looking for. This page, I love this page. What is a PE ratio? So we just learned the value of a stock is dividend divided by KE minus G. Didn't we do that? The dividend discount model. What is the dividend? It's earning per share times payout. Isn't that the dividend? What is KE? Isn't it risk-free rate plus beta times the market risk premium? How do we get a price to earnings with this formula? Just bring the E over here. So look at that. I would have that in my wallet if I were walking around. This tells you a huge amount about PE ratios. A PE ratio is the firm's payout ratio divided by interest rates plus how risky the stock market is times how risky the company is minus the company's growth. So what does that mean? We're dividing by this. What happens to PE ratios when interest rates are high? You increase the denominator, what happens to this number? Huh? It goes down. So in 1980, when interest rates were really high, guess what PE ratios were? Really low. PE ratios were like 9 and 10. Today, they're like 25, 20. Well, I don't know what they are today. It's a little lower today than they were yesterday. What happens when markets are worried about risk? PE ratios are going to do what? They're going to drop. What did PE ratios do in 2008? They dropped because everybody's worried about risk. Those two relate to all stocks. So stocks in general, when everybody's worried with higher interest rates and everybody's worried about risk, that's when PE ratios are lower. How do you know when MRP is high? What one ratio could you look at to see if? Can I try this ratio? Have you heard of the VIX? The VIX is at 15. Is that particularly high? That's pretty average. It's higher today, right? Because the market's selling off today. 15's pretty average. Essentially what the VIX is what the market thinks the stock market risk is going to be in the next 3 months. And it's essentially this annual standard deviation of the stock market. The annual standard deviation of US stock market is about 15 to 16% if you don't go back to the Great Depression. To go back to the Great Depression, it's more like 18, 19%, but 15 is a pretty normal number. Why did it jump up here, do you think? March of 2020. COVID. Why did it jump up here in September 2008? Lehman Brothers crashing, right? So you can see, and what do you think PE ratios did right there? They nosedived, right? So that's the VIX. It's really important to understand that these two relate to all stocks. The beta and growth are specific to your stock you're looking at.
Yeah.
Hmm?
What could it be too bad, not too high? Just like that, everything.
Well, why would PE ratio be high? So if interest rates are really low, PE ratios are going to be much higher. So PE ratios are pretty high right now, even with interest rates higher. But a few years ago, PE ratios were high, but interest rates are really low. People say that's normal. That's fine. And the market risk premium has actually been pretty low for quite some time. If you look at it, we've been pretty low level for some time. You know, you go back 5 years maybe. It's been trading really low. Now it does occasionally fall down to 10. When it falls down to 10, I'm doing option trades. I can tell you, I'm making some bets because that means options are really cheap. Options are really cheap. I love to buy options. Right. So when you get specific to the company, beta is the measure of the risk of the company. If the company's really risky, what's that going to do to their PE ratio? You increase the beta, what's the PE ratio going to do? It's going to be much lower. So risky companies have low PE ratios, which means if you're looking at a firm with a low PE ratio, you might think, wow, that's a really inexpensive stock, but it could just be a really risky stock. You could be tricking yourself.
What number would be like low?
For a PE?
Yeah.
See if I can find you one. So we know a high one, right? NVIDIA, that would be a high PE ratio. So their PE ratio is 73. All right, that's pretty high. Let's look at Ford. I'm not exactly sure. So Ford is at 12. That's kind of a low PE ratios. Now, I don't know if I can show you Macy's or not because I don't think they're making money right now, but their PE ratio was really low recently. Yeah, it's really high now because they went from a really low PE ratio to them not making money and now making a smidgen of money because their earnings are distorted. I'm trying to think of a low PE company, but that's tough to do. Yeah, I can't be. I'd have to go on the Bloomberg and look at it. Now, there's some that are surprising. You would think Walmart would be a low PE stock, but what do we know about what their beta is? High risk or low risk? Low risk, and a low risk company can have a pretty high PE ratio. That's actually higher than the S&P 500. It's not because they're a high growth company, it's because they're a low risk company. And so that's the key with this formula. If the risk is low, you get a high PE ratio. If the growth is high, because we're subtracting growth, if growth is high, you get a high PE ratio. Right? So PE ratios can be high because the risk is low or because the growth is high. Why do you think NVIDIA's PE ratio is so high? Growth. It's not because they're a low risk company. All right. And why is Walmart's PE ratio pretty high? Low beta. Their growth isn't particularly high right now. All right. So you see why there's a lot in this formula. Now I'm ignoring one number. What number did I ignore? What's in this formula I didn't talk about? The payout. Why did I ignore payout? Because in 3013, they told you, and we talked about it here, if you increase your payout, what happens to your growth? If you pay out more in dividends, what happens to your growth? It goes down. Financial theory says these perfectly offset each other. If you reduce your payout, you grow faster. You increase your payout, you grow more slowly. So ignore payout because it's essentially just offset with growth. So you don't have to really look at payout at all. You just have to look at the growth piece. But there's so much in that ratio. Why are PE's ratios high or low? Has to do with interest rates, risk, and then specific to the company specific risk, and the company specific growth. All right, so these are old numbers. Tesla used to have a PE ratio of 1,081. That sounds kind of high. It's a pretty high PE ratio. Kroger was at 11. Kroger, you think would have a high PE ratio, wouldn't you? This is low beta. Why does Kroger have such a low PE ratio? Couple of things. First, it's got a lot of debt, which makes it riskier than its beta. But secondly, Kroger was really struggling there. What's Kroger try to do here recently? Try to buy Albertsons, not going too well, but Kroger's struggling. Why? It's just, well, there's a big gorilla that's competing with them. Actually, two big gorillas, Walmart and Dollar General. I don't know if y'all seen the news stories on Dollar General and some of its problems, but Kroger was struggling. But Kroger is, I think, has come back a little bit here recently. I think it's KR. They had a big jump there. So came down pretty strong, but then recently have come back up. But there was a time, and I haven't looked at them recently, but there was a time their debt to equity was just really pretty pathetic. Yeah, 229% debt to equity. In most firms, it's 40-50%. That's a lot of debt. So Kroger is essentially just betting the farm on whatever they're trying to do to catch up. How many of y'all shop at Kroger's? You can shop at Kroger's in San Antonio. How would you do it in San Antonio? They have home delivery, right? Which is so bizarre.
They canceled.
I don't know if that's stopped in in San Antonio.
They canceled.
I have they really the last store or the last home delivery? Because they were doing their home delivery in San Antonio, but they shut all their stores down, and then Albertsons left San Antonio. Is that because of Walmart? Because of HEB? You can debate which of those is the bigger competitor. Walmart's pretty high, but that's because they're low beta. Amazon was high, probably because of high growth. So is Kroger cheap? Yeah, it's cheap. Is it slow growth? Yeah, probably. It is high risk and not really on the beta side, but it does have a lot of debt. So when you see a stock with a high PE ratio, you don't know if it's an expensive stock, a low risk stock, or a high growth stock. You can be any one of those and a combination of all of them. That's you see why you have to have both risk and fundamentals in there. Growth is a fundamental, beta, debt is a risk. You got to make sure that's in your model. If you don't have that in your model, you're going to get some really bad stock suggestions. All right, so here's the key on the exam. Our numerators are going to be either price or enterprise value, and a denominator is going to be earnings, book value, or revenue. When do you use price? You use price anytime you're dealing with something that's after interest expense. When you use enterprise value, anytime you use something that's before interest expense. Book value is after the debt holders. So you do price to book. Revenue is before interest expense. So you do enterprise value to revenue. You don't do price to revenue. Earnings, if it's earnings per share, that's price to earnings. But the BI, what does that mean? Before interest. I hear students saying earnings before income tax, but that's not right. It's earnings before interest expense and taxes. So anything that is BI before interest, you're always going to use enterprise value. You don't use price. There's no such thing as price to EBIT. There's no such thing to price to EBITDA. There's really nothing, there's no such thing to price to revenue, except for Yahoo messed up. And look what Yahoo did. Price to sales. They have enterprise to sales. That one's correct. This one's just wrong. You use price to sales, the value of stock. What you're going to end up with is not cheap stocks, but with companies with a lot of debt. Your model's going to say they're cheap because you should have added debt to your numerator and you didn't. So you don't want to use price to sales. So it's critical you line up the capital provider with the ratio. When do you use stock value? When you use enterprise value? So the earnings base, these are the earnings base, price to earnings, EV to EBITDA and EBIT. And then the PEG ratio, I count that as one as well. We talked about the PEG ratio last class. That's the PE ratio divided by growth. It's essentially taking the PE ratio and putting a fundamental in there because growth is a really key one. So you're saying, wow, that firm has a high PE ratio, but it has high growth, so I'm okay with that. So you're trying to adjust that PE ratio so you can see if it's too high or too low. Remember when we looked at NVIDIA, and NVIDIA had a really high PE ratio, but their PEG ratio wasn't that high because the market's expecting such high growth. Book value at price to book, or one I really, really like is price to multiple year earnings per share. We'll talk about why that would make sense. A good example is McDonald's right now. McDonald's book value is negative. So you can't do a price to book value, but you can take McDonald's earnings per share the last 10 years and do a price to that. That would work. So their earnings the last 10 years is not negative. Why is their book value negative? Because they bought so much of their stock back, they pushed their net worth to be negative. So price to multiple years earnings per share can work as a substitute for price to book. And that's a pretty easy number. I think Bloomberg may even have that ratio that you can actually pull it in as a number. And then revenue base is just EV to sales. Ignore Yahoo Finance. Price to sales, price to revenues does not exist. You don't do that.
Why is that one not good, the price of sales?
Well, because price is only stockholders. All right, so sales before interest expense. So if you do price to sales and a firm has a lot of debt, a firm with a lot of debt's going to look really, really cheap. But when you add the debt back in, they're going to look expensive. So a firm like Kroger's, you do price to sales, like, wow, that's a really cheap stock. Then you add that billions of dollars of debt back in, and suddenly their prices, their EV to sales is much, much, much higher. I might be able to, I shouldn't do this on the fly, but let's see if we can do this with Kroger's. So, but yeah, perfect. Right. The price of sales is 0.23. Wow. Thanks, Carlos. That's a perfect example. That looks like a really cheap stock, doesn't it? What's their enterprise value of revenue? 1.35. That doesn't look so good, does it? Makes a big difference if you do that. Yeah, perfect question. So yeah, you buy Kroger's, wow, it looks so cheap, price of revenue, you end up with a firm with a bunch of debt. So maybe it wasn't such a cheap stock after all. Now the question is, when do you use which ratio? And that depends on your industry. All right, so this is the last thing you have to do on the exam. When do we use earnings base? You can use earnings base for anybody. Price earnings works for all industries, but specifically technology companies, high growth companies, communication services firms. So Microsoft, those type of firms. In fact, the most favorite one for tech stocks is EV to EBITDA. Everybody loves EV to EBITDA. Dr. Demodoran says it's because finance people like saying EBITDA. I don't know if that's it or not. It sounds sophisticated. I think the reason they like EV to EBITDA is it's the lowest number. Because EBITDA is the biggest number. You take price of EV to EBITDA, you get the lowest. So typical PE ratio might be 25 and EV to EBITDA might be 12. And the Mandarin says, if you can go to your boss and say, I want to buy this stock, and you say it's trading at a 12 multiple, that just sounds better than saying it's trading at a 25 multiple, even though they're not even really comparable. So yeah, if you're doing Microsoft, Amazon, Meta, Alphabet, you're going to use an EV to EBITDA more than likely. Book value based have three categories. Firms with really high property, plant, and equipment, a lot of capital employees. And I mentioned, Intel's a tech company, but Intel's a tech company that builds a lot of fabrication plants. So they have a huge property, plant, and equipment. So Intel, you could debate whether you use EV to EBITDA or you use price to book because they have a lot of capital. But manufacturing firms, utilities, price to book is where you go. The second category are very cyclical firms like Exxon are still manufacturing, where their prices of what they sell are really volatile. You don't want to use earnings based because if oil prices are high, Exxon looks really cheap. If oil prices are low, it looks really expensive. So you want to use price to book to kind of spread that out, or even better, price to 10 years of earnings. So you go through the whole cycle and you can see what they look like. So cyclical and commodity-based companies. And then the last category is my category, which is financial services. Banks and insurance companies always use price to book. Any firm that's just heavily focused on return on invested capital, or you can use price to book. Now the world has really changed here. Banks used to trade at a price to book of 2 to 1. But you look at Citibank and their price to book is 0.52, which is shocking. That means you can buy Citibank at a 50% discount to what the accountants say it's worth. And I thought you were taught in your accounting class that a GAAP accounting was supposed to be conservative. And yet you can get Citibank at a 48% discount to what the accountants say it's worth. That's not normal, right? If I look at NVIDIA, their price to book is 45. So would you rather buy Citibank at half what the accountants think it's worth, or buy NVIDIA that's 45 times what the accountants think? So now what about JP Morgan? They're above 1, so that's good. They're getting back to the traditional 2, that's fine. What about Cullen Frost? You think they're higher than JP Morgan or lower? Higher. Why is Frost so expensive? Frost has one thing everybody wants. It's their loan to deposit ratio is one of the lowest in the industry. They have a lot of deposits and they haven't loaned much of it out. They'd be a great takeover candidate. Yes, so their loan to deposit, which means loan to deposit ratio might be a great ratio to bring into a bank model. Because, think about Goldman Sachs. They're trying to become a normal bank. What they love, they pick up massive amounts of deposits without a lot of debt, without a lot of loans. That'd be great. So Cullen Frost, I don't know if it's the most expensive bank out there, but it's a pretty expensive bank.
Better, but they don't own much.
No, that's what I meant. It has a low loan to deposit ratio.
Well, no, you said that they're overvalued, but they think they're going to think that they're overvalued.
Well, they could loan a whole lot more. That's why the market loves them so much. All right, sorry, I hit the wrong button. The last category before we all don't leave yet. The last category is revenue based, which is simple. Anything related to retail, you use EV to revenues. Real simple. Any retail company, there's a lot of them, use EV. All right, well, we'll start here in this next time. I can tell you I'm already going.